Hi, I'm Samir Jain. So earlier we had spoken about the US equity market in 2020. So today I'm going to turn my attention to what's going to happen not just in the US but in developed markets, in Asia and emerging markets. Essentially think of it as arriving at some sort of forecast if we were to enter equities this year and looking at a very long-term future. So this year we've seen a broad decline, not in the equity markets, those have held up, but in the stock bond frontier, those returns have been meaningfully lower than last year. And this really is because yields on bonds have been extremely low. The combined impact of ultra easy monetary policy that has compressed yields. And meanwhile, fiscal stimulus as well as an inordinate amount of monetary stimulus together has boosted equity valuations. But for the future, I'm going to lower my equity market return assumptions across pretty much all regions. I do expect a normalization of global growth and valuation somewhere towards the middle of next year. I do expect the US dollar to weaken relative to key developed market currencies, and this I think will provide a tailwind for the attractiveness of markets outside for the US dollar investor. I think that developed market return assumptions, which is really Australia, New Zealand, Europe, United States, is going to benefit from an expectation of a higher GDP growth, and that's going to come by a post-pandemic economic recovery. Of course, this impact is going to vary amongst countries, but overall I think it's going to deliver a boost to revenues. It's going to increase earnings growth, and this is going to have some impact because we are starting from a very low starting point for earnings. I also think that a lower level of developed market equity payouts, reduced buybacks, lower dividends, that's something we should expect over a 5-year expected horizon. But because money is so cheap, one would expect a generally supportive leverage environment. After a long time, one would expect non-US equities to significantly outperform US equities. I don't know what that number is, but you've seen in the US, these markets have already reached very heady valuations. So in this current cycle, the PE is almost 22, 23. So over the last 10 years, this outperformance, where we've outperformed emerging markets, is set up really for a reversal. So in the US, my profit margin assumptions are unchanged. I think that the existing level of margins is really near historical averages. And you have certain sectors where margins have been expanding, and that's well known. Technology is one, and technology now has an increasing revenue weight in most indices, especially the large cap S&P 500. And those indices that have shrinking margins, such as energy, have a much lower revenue weight. And if you look at margins in Europe, they're pretty much in line with what has existed in history. But Europe is slightly different from the UK. In the UK, I was looking at the numbers. The margins are lower than the average, and I think this is because it reflects an overweight to old economy companies, and these companies we know this year have faced profit pressures. And don't forget, there is this uncertainty about the Brexit outcome. So I think some of these may offset any cyclical tailwinds. In Japan too, margins are running below what one would expect the long-term equilibrium to be. But they seem to be okay in industrials, which have benefited from some global secular trends, largely trends in mechanization, in automation. But Japan is all going to be a governance story until you have governance-led reforms that ultimately strengthen profitability for Japanese companies. Things are pretty much going to be what they are. So I have, despite this growth in PE, I do think that we can still assume a slightly higher increase in PE in the US, UK, the Euro area, and Japan. So this rising trend in PE ratios, there's really no reason to believe that this will not persist. And the drivers are very low interest rates, corporate decisions to use higher levels of payouts using buybacks and dividends, taking on more and more levels of balance sheet debt to support higher ROE. So these are general things that one would expect. But over the long term, I would lower my US equity market risk premia and perhaps expect an overall return of 4.5%, which I think is a big reduction if you look at the US versus some of the other developed markets. So having said that, earnings growth is going to pick up. We would expect, as I said, buybacks and dividends will provide a significant component. But here's the thing: the positive impact of these forces, this is going to be considerably muted, largely by valuation normalization. Valuations are pretty high, 23-ish or so. Almost 1.65 standard deviation from the historic 15-ish or so. So US equity markets have made new heights on the back of very coordinated monetary and fiscal stimulus. And investors have really looked through, and that has been really the conundrum, they've looked through deteriorating corporate fundamentals, which has pushed valuations up. And even in UK, Europe, Japan, equity, one might find very similar dynamics. Though I think that UK equities look generally attractive because they are relatively cheap. They're cheap when you compare it with other markets. In themselves, they may not be very cheap. So they've offered a sizable dividend yield, and one would expect the equilibrium PE ratio to be 14, 15, 16. So while some people see UK equities as expensive, I think that in relative terms, the negative drag that's going to come from valuations is smaller than in other markets. This might make intuitive sense too, given the significant underperformance of UK equities. So UK margins have collapsed a lot more than other developed margins, largely during the COVID crisis, and we know pretty well why that's happened. They've bungled the response to the COVID crisis. Of that there is very little doubt. And Europe too, I would downgrade my Eurozone equity assumptions to maybe 5.2, 5.3% annually, as is the case in many other markets. So once again here too, much like the US story I told you, the positive impact of higher drivers is going to be attenuated by the valuation assumption that's going to be overwhelmed by the negative impact of last year's significant rise in PE ratios. So one would expect a small decline perhaps in dividend yield. But the good news is Europe has taken very significant steps, and I've talked about this separately. Stimulus, a collective fiscal policy for the next 5-7 years. So all of this is going to pave the way to a deeper and more integrated European capital market. So I think Europe generally is in a pretty good way. It's better positioned to capitalize on growth in certain areas. For example, environment, they are hugely bullish on environmental technology. Moving on to Japan. In Japan too, my return assumptions in the Japanese yen local currency terms might be say 5% or so. And the hit to earnings from COVID-19 has left the market looking somewhat more expensive. So that's something to kind of take to kind of keep at the back of your head. Emerging markets equity looks a lot more interesting. I would still expect a drop in EM equity in local currency terms, and even in terms of the US dollar, it would still fall to maybe 7.5% or so. So in 2020, emerging markets equity outperformed developed market during the bear market. They lagged in the rapid global rebound, largely because people really didn't know how the corona crisis would play out. And they received a boost in the second half of the year, in the last few months, where there was this very furious bull market in China, which lifted the whole emerging market complex. And this is interesting because this followed several years, as I had said earlier, of challenging performance for emerging markets equity, and that had eroded its long-run performance over the last decade. But China has done extremely well. In fact, it's one of the few markets that have held on. But valuations have risen substantially across the EM universe. Though, of course, if you were to compare it with developed markets, it's been a lot more modest. But having said that, what I find is at the same time, earnings and margins have fallen. That have offsetted some of the headwinds from valuations, a story that has not happened in developed markets. And one would expect modestly lower GDP growth assumptions from a structural perspective. But of course, we know very well that in emerging markets, the relationship between GDP, economic growth, and the stock market is very, very tenuous. So the challenging US-China relationship could, who knows, impact the EM landscape over the long term. But right now, I would incrementally lower my overall assumptions of economic growth forecasts. And here too, when we speak about emerging markets, it's more and more important now during this corona crisis to differentiate Asia, where the effects of China's secular growth or if there's going to be slowdown, are going to be very keenly felt. But relative to developed economies, EM growth potential still remains substantially higher, due mostly to still higher potential for example, productivity catch-up outside certain parts of East Asia. And of course, those secular drivers, they haven't changed. More favorable demographics. As I said, I assume that the US dollar is going to weaken. So this should also prove supportive, because it gives emerging markets central banks policy space, and it also alleviates pressure on emerging market borrowers. I would urge you to continue to note the dispersion amongst returns in individual emerging markets within this broader index. So Asia is very, very different from Latin America, and there is a lot of variation in market structure, in sectoral composition, even corporate governance, even the existing sovereign balance sheets, their external exposure. So the spread amongst individual emerging market returns is likely to remain very high. So which EM market you want to be is extremely important, unless of course you want to hold the index. The other interesting thing is, in emerging markets, the capitalization of new stocks that are being issued that get added to index indices, the number of listed shares increases, and this dilutes the portion of the pie that's owned by existing shareholders. This dynamic is very different from developed markets. So that's why I said that faster economic growth does not necessarily result in faster earnings per share growth. Keep that in mind, and often we confuse the two, because this leads to a higher net dilution for emerging markets than for developed market indices, and this has a 2-3% drag on emerging market equity returns relative to developed market returns. And speaking about the divergence in the performance of different regions, this year it's been very wide, largely because of the corona crisis, because commodity sensitive markets in Latin America and Middle East, Africa regions have been hit harder by the COVID-19 crisis than emerging markets Asia. So we've had very poor performance by Latin American equity, and I think it would not be imprudent to raise expected returns for LATAM to maybe 8% in local currency terms, and this should mainly reflect an expectation of improving profit margins in Brazil and in Mexico too, and these are the big pieces in LATAM. So of course, weaker commodity prices, the current margin levels are well below the equilibrium long-term margin assumptions that we've had. So that's the story with the emerging markets. But let me turn to South Africa. I would raise my expected return for South Africa to maybe 10-11%, and it's been helped by the positive impact of low current margins, upgraded dividend assumptions. So this variance is very, very important. So this generally has been my takeaways after reading what other people have been talking about, after looking at our own models, as to what the expected return for different developed markets and emerging markets indices ought to be if one were to enter the market at this point in time. And this is of course a long-term assumption over say 5 years or so, but of course there'll be lots and lots of opportunities to fine-tune these in the next in every 6 months actually. So thank you so much for listening in.